Greetings, everybody. Nice to see you all. Well, at least you can see me, and I can see that we have a nice group of folks that joined in today. So I thank you for taking some time out. I try to keep this to about half an hour, in all due respect to your time, and usually try to cover my monologue in about 15 minutes, and then open it up for Q&A for 15 minutes. So let's see if I can accomplish that again today. Nice day here in Long Island. It's sunny. We had a little bit of snow a couple of days ago that right away was followed by rain. So all in all, we haven't really had much of a snowy winter so far, knock on wood. But let's talk about things. Clearly, the market's not happy today. We're seeing more upward pressure on energy prices, which should be good for the S&P 500 energy sector, which did really well last year. Looks like it's going to do well this year as well. I've been thinking the energy would do well to a large extent because of the impact of climate activists on reducing capital spending by the energy companies, which would then tighten up supply and demand relationships in the marketplace, leading to higher oil prices. But I also thought that some of the fracking activity in the US would pick up as oil prices went up. So 65 to 85 on Brent is what I've been expecting. But now we're at 85, so we're getting close to seeing the range move to the upside. And that obviously related to some geopolitical disturbance in the Middle East, which is always prone to geopolitical disturbances. So that's the way it is. So we'll see how that plays out, but that's got the bond market jittery because that would mean higher inflation led by energy. And already we see that the 2-year Treasury note is above 1%. So the fixed income markets are clearly discounting 4 rate hikes, or maybe the first one as much as 50 basis points instead of 25 basis points. The Fed doesn't have to take baby steps in tightening. It could get a little bit more aggressive for starters, and then make it a little smaller increments. That's if they want to have an impact on inflation psychology. And I think that they clearly do want to do that. They've turned more hawkish. What this probably means for the stock market is what we see is what we get. We're going to get sideways volatility if we're lucky. I don't think we're going to get a bear market. We could get a correction out of it. I think in dropping from 4,800 to 4,600, that's about a 4% decline in the S&P 500. Clearly within that, there's more pain and more gain in other areas. The pain has been mostly in growth, and the gain, or on a relative basis, the outperformance has been in value, and that may very well continue. I still like the 3 sectors: energy, financials, and information technology. I think this could turn out to be a good buying opportunity for some of your favorite IT kind of names. I think IT continues to be extremely important in the capital spending capital spending that I see ahead, which is necessary, essential to offset the fact that we've got labor shortages that are chronic. And so I think companies will have no choice but to continue to spend a lot of money on capital equipment and technologies that boost productivity. With that, let's do some analysis of valuation in the marketplace. So let me open up my share screen here and go from the intro to the chart collection. By the way, I noticed that one of my 3 puppies, Chloe, decided to spend some time with us in the previous call, and she was looking over my shoulder, and then she finally started barking that she wanted to get out. I'm working from home today solo, so my wife's out and the kids are in schools, college, I should say. So if Chloe decides to knock again on the door, I guess I'll accommodate her, since you've already gotten used to her. But right now, I don't hear her, so we can proceed without interruption, I hope. The stock market valuation is one of the issues that I addressed in the morning briefing today. The other issue is the whiff of stagflation that last week's data brought home to the marketplace, and clearly that's also not a happy story. Before I go any further, the happy story is Joe just did an update on forward earnings for the S&P 500, and they continue to rise to new record highs, which is very impressive under the circumstances. So the earnings picture still looks good to us based on our weekly indicator. But overall, the macroeconomic environment is starting to smell a little bit stagflationary, as I mentioned. We'll look at that in a second. For now, let's look at valuation and where the risks are in valuation. There's certainly more risks than there are opportunities when it comes to valuation. The Buffett ratio is one of the most widely recognized measures of valuation, one of the metrics that people look at. Most people look at forward PEs, but what the Buffett ratio does, it looks at a much broader mix. It divides U.S. equity market capitalization, as you can see here, excluding foreign issues, by nominal GNP, and that's the blue line, as you can see. And everybody's felt for quite some time, and back here, Buffett was on record saying that, you know, whenever this thing gets close to 2%, that's when he gets nervous. And look where we are now, we're at 2.7%. Related to that is the S&P 500 market cap as a ratio of the S&P 500 revenue. So it's a very similar kind of market capitalization ratio, and very similar to the broad Buffett ratio. And it too is available quarterly. And as you can see, it's actually at 2.9%. So if 2% was dangerous, what can you say about 3%? It's even more dangerous in terms of having a lot of air between the market cap and the underlying revenues in the market. Then we can look at this second panel in the chart and see that the S&P 500 market cap is as a ratio of revenues, which is the blue line, and we just looked at it in the first panel, is highly correlated with the forward price to sales ratio for the S&P 500. So what I'm indicating here is that we don't have to wait for quarterly data on the Buffett ratio. We can just as well do it with our weekly indicator, which is the forward price to sales ratio. And again, it's 2.8%, well above what the Buffett ratio was back here. Now let's come to a conclusion on this and see that compare the forward PE, which is this scale, versus the forward price to sales ratio, which is that scale. And you can see that they're pretty highly correlated, different scales, but very highly correlated. But notice that while the price to sales ratio, the Buffett ratio on a weekly basis, continues to climb into record high territory, the forward PE ratio for the S&P 500 is actually trended down somewhat. I think I've kind of been looking at as range bound around 2 to 2.4%. But you can see that it's not percent, it's a ratio. So that's what we can see here. I'm sorry, let's do that again. It's been 21 to 23 for the forward PE, whereas the Buffett ratio, I should look on this side, is all-time record high. How can we account for this divergence? Well, it's pretty simple. The margins, the profit margins have been increasing substantially in the S&P 500. So we've got revenues going up, but we've got earnings going up even faster. So while the Buffett ratio looks very worrisome, you maybe get a little comfort, just a little bit of comfort, from the fact that the earnings picture from a price earnings standpoint is not as bad and has actually come down somewhat. Still high at 20.9, but not what we saw back here for the forward PE, which was readings of around 24. Well, again, the margin's been doing great. And we have a way of looking at the margin on a weekly basis, again, dividing forward earnings by forward revenues. And as you can see in this chart here, it's continued to climb, but it looks like it's starting to get kind of toppy. That doesn't mean it has to go down. Typically goes down in recessions, but very, very impressive to see the profit margin holding up at record high territories in the face of labor shortages, rising labor costs, rising commodity costs, supply chain disruptions, and so on. To me, it indicates that productivity must be making some sort of comeback, which it has been actually since 2015. Well, again, let's drill down some more in the valuation story here. And this is the price to sales ratio, looking at the S&P 500 2.8 versus what that looks like excluding the mega cap 8. I used to call them the magnificent 8, but I felt that that wasn't really consistent with what we usually say, which is large caps, mid caps, small caps, and now let's call it mega caps. Mega cap 8 are the 8 largest capitalized companies in the S&P 500. And you can see their Buffett ratio is off the chart at 6.6. Take that out and you get 2.3. Again, gives you a little bit of comfort. But then again, it maybe gives you some discomfort with the fact that 8 stocks have such a high Buffett ratio. Makes you kind of hope that they can deliver on earnings growth, because clearly the market's concerned that as growth stocks, rising interest rates, rising bond yields are a negative for their price to sales ratio as well as their PE ratio. Let's look at the PE ratio. And again, the S&P 500 is 21.1. The mega cap is at 32.3, and excluding them, it's 18.7. Not terrible. I mean, it's high. I think most people think that kind of a very reasonable PE for the market is 15 during normal times. And we're still, I think, in somewhat normal times. We're not in a recession, certainly, but 18.7 doesn't seem to be extremely high. But where we do have the issues in this 32.3. But then again, one of the stories I've been telling to explain that is that a lot of money has come out of actively managed equity mutual funds and has gone into ETFs. And actively managed money can't have just 8 stocks dominating its portfolio. Portfolio managers have to rebalance when it gets to 2, 3, 4% of their portfolio. Many of them are required to by their mandates. And so they're forced to rebalance, get out of those stocks to a certain extent and put their money elsewhere. Whereas ETFs, if the S&P 500 winds up being just 8 stocks, so be it. That's what the ETF will be. It's not actively managed. There's no valuation parameters that require any sort of rebalancing elsewhere. So I think that's been a big part of the explanation. But of course, the fundamentals of the Meg Cap have also been really quite good. And you can see that in the forward profit margin. I mean, people are willing to pay a higher PE, a higher PS for companies that have very high profit margins. And the Mega Cap 8 have a profit margin of 20.4. The S&P 500, including them, is 13.3. The S&P 500, excluding the Mega Cap 8, is 12.5. And then just for fun, let's take out Amazon, because a good part of its business is retailing, and that's a low margin business. But you can see that the Mega Cap 8 altogether is 20.4. Take out Amazon and there's 27.8. So the profit margin justifies the high PEs and PSs of the Mega Cap 8, at least relative to the rest of the market. It doesn't justify them if they can't get enough revenues growth to take advantage of their high profit margin. But so far they are. And as I said, the forward earnings of the S&P 500 through the latest week, according to Joe, continue to rise into record high territory. So is there a case to be made for IT? Well, from a fundamental perspective, IT looks great. It's the valuation issue that's the problem. And by the way, only 3 of the mega cap names are actually in the technology sector of the S&P 500. It's Microsoft, NVIDIA, and Apple. There's a couple in the communication services and a couple in consumer discretionary. But so it's not, you can't really do apples and apples when you look at the capitalization share of technology in the S&P 500. It was like 33% back here. Now it's 28.6%. But the earnings share is well above the peak here, which was around 18%. Now we're at 22.4%. So the fundamentals still look quite good for the technology sector. Semiconductors are leading the way in terms of solid fundamentals. Here's worldwide sales, and here's semiconductor forward earnings, which we can watch weekly as a proxy for that. And you can see that both are in record high territory and continuing to trend higher. Industrial production of semiconductors, that's this orange line here, you can see continues to trend on a upward trend. Almost, I guess, yeah, that is record high. Even more so is computer and peripherals. By the way, communication services remains, communication equipment remains on an upward trend. And that's the green line. Dipped a little bit here, but you can see that the tech wreck back here was actually led by communications equipment, a lot of seller financing. And then, of course, there's a lot of Y2K preparations, but all that is not the issue here. The issue here is demand going up or is it going to go down? And I think demand is going to continue to be very strong in the technology area. Let's quickly talk about the stagflation issue. Looks like Omicron is not as lethal, not as deadly as the Delta was, but in terms of case counts, it's absolutely soared because it's spread so quickly. In terms of hospitalizations, it's been bad, worse than the Delta when you look at the number of cases. But again, it's less lethal. People recover from it more quickly, and there's fewer symptoms from it. Nevertheless, anecdotally, we're hearing about, all of us are hearing about lots of people calling into work sick. They've got COVID, they got Omicron, they've got to stay home, they're not coming to work. And that's likely to have an impact on the economy in the first quarter. Looks like real GDP so far, according to the Atlanta Fed, is coming in around 5% now. It's been, the estimates have been coming down, but 5% is still pretty good. But it looks like Omicron could have an impact on growth. We're looking 2.5%, 3% for growth in real GDP in the first quarter. And that, of course, can impact supply chain disruptions, which could continue to have an inflationary impact on the global economy. Retail sales, you can see there was a disappointment here. It was down quite a bit in December. So right away, the analysis was Omicron and higher inflation are depressing consumer spending. But don't forget, it's at an all-time record high territory. We're well above the trend here. But I think increasingly we have to account for inflation clearly in looking at retail sales. And when you look at real retail sales and look at the trend before the pandemic, you can see that we're actually back to trend. So I think a lot of pent-up demand has been satisfied, which explains why we're seeing some weakness in retail sales. And getting back to trend kind of makes sense. Maybe you could undershoot it for a bit here because of the latest variant of the pandemic. But I think as we get into the spring and summer, we'll find that retail sales continue to grow along with employment, along with real wages. So business, if consumer spending is slowing here, don't panic about real GDP, because I think that would actually provide businesses with an opportunity to rebuild their inventories. And as you can see, inventory to sales ratios in nominal and real terms are extremely low, and there's plenty of room for rebuilding, and that could be the offset to weaker consumer spending. Well, on that's the stagflation part of it. I don't think we're going to see chronically weaker economic growth. Slower growth, yes. Are we going to go back to 2.5% to 3% growth? I think so this year. And if we get a surprise to the upside, it's going to come from productivity, which would be a good thing. But in the interim here, we've got an inflation problem in this stagflation scenario, near-term stagflation scenario. And you can see that the CPI in December was 7.1%. The PCED lags by a month, but they're highly correlated. CPI sometimes is higher than the PCED. Look at durable goods. Now look at durable goods closely here. Look at this December, 16.8%. This has been a big source of the inflation problem, and this could be a big source of the disinflation that I think is coming in this by the second half of the year. We know that used car prices are up over 50% in the past 2 years. We know that new car prices are up almost 12% over the past 2 years. I think as that market finds some semiconductors to finish up producing cars, both used and new car prices will come down. Bedding prices, furniture prices, those things, if they don't come down, they'll stop going up like this. But that's something to watch. Non-durable goods, we now, at least today, are worrying about energy inflation again, and that could continue to be a source of inflationary pressures in the next month or two. The services, I don't think is going to go away as a problem, particularly rents. Home prices over the past 2 years are up 30%. I think it's priced out a lot of would-be home buyers, first-time would-be home buyers, so they're going to stay in the rental market, and that may very well continue to put upward pressure on rents. So all in all, I think inflation is going to be ranging around 4 to 5%. May have to raise that a bit through the middle of the year. And then I think by the second half of the year, we'll find that inflation moderates somewhat to 3 to 4%. But I don't think we're going to get back down under 2% for a while. And so that's certainly consistent with the Fed continuing to raise rates. I do think we'll see 1% Fed funds rate by the end of the year. And we could see 2% on the bond yield within the next day or two, the way things are going. But get to 2%, I think we'll all start talking about 2.5 to 2.75%. I don't think these are going to put the brakes on the economy. They may help to bring down inflation somewhat, but reducing the supply chain and disruptions, increasing productivity, I think those will be the key to bringing inflation down. But the Fed, because of its easy monetary policy, has contributed to an issue here with rent, as we can see with home prices up 30%. And there's a picture of the rent inflation. So that's my story for you today. Why don't we open up for some questions? I don't see any so far, but I invite you to send in your questions. And I've left about 6 minutes for me to cover what's on your minds. Okay, from a long-term view, do you think the Fed will continue with their plan for rate hikes? Will last long, or will they revert back from it in the past? We've had 3 previous tapering tantrums where the Fed either started to talk about raising rates or actually was raising rates. We had one in May 2013. We had one in 2015-16. We had another one in 2018. And then there's this one. The big difference, clearly, between this one and the previous 3 is back then inflation really wasn't a problem. So when the markets had a taper tantrum, a hissy fit about the Fed raising interest rates, the Fed could back off without any major consequences. This time around, they really can't back off. For the sake of credibility, for the sake of showing that they really do have concern about inflation, to the extent they realize inflation is disruptive to economic activity. In his nomination hearings, Powell said that we can't keep the economy growing if inflation continues to move higher. So we have to address it. Of course, a lot of us think that they are addressing it a bit late and that they're behind the curve, but they are going to be raising rates. And I think that it may not take, I don't think the Fed funds rate is going to get to 2.5 to 3%, but could it get to 2% in 2023? It could. And if it does, it'll be because the economy is actually doing pretty well and can stand some further tightening to bring inflation down or to keep a lid on it. Okay, Michael, how long will zero coupon bonds like stocks, emerging tech, and biotech continue to fall? Good question. And it's a good analogy that with the Fed just threatening to start tightening, with the bond yields starting to finally move higher, it's finally back to acting normally. it's clear that zero coupons kind of securities, bonds, and stocks have gotten whacked pretty hard. The answer to your question is I think a lot of these stocks will continue to be hammered for the next several months as bond yields are in fact moving higher. As you know, Kathy Wood's ARC funds have a lot of these kind of zero coupon kind of stocks, and they did really great on the way up in 2020, increasing like 150%. But once the market started factoring in that the Fed was getting closer to tightening, they gave back, last I heard, was about 40 to 50%. So they still have room to get whacked some more again. The problem is they don't have earnings, and that makes it very hard to value them in an environment where interest rates are rising, or it's hard to value them at a high multiple. William, okay, Kathy Woods is saying inventories are starting to build. Well, I hope they are, and we're talking about Kathy. She's actually a very good friend, and she used to be an account, but she got into an area of the market, I guess, that she figured we weren't giving her much, and she knows everything about those stocks. But Kathy is a smart lady, and I would say that inventories hopefully are starting to build, because I do think we're entering a period here where the consumer will finally give businesses some slack in demand and some opportunity to rebuild inventory. So that would be a positive all in all. I don't see that as a negative. I know she's been talking about deflation as her scenario for where we're going with all this, but I'm sympathetic to that possibility. You know, I've been talking about the 4Ds, deflationary forces, for quite some time, but I'm pragmatic. I look at the data, and the data shows that we overdid it with excessive fiscal and monetary policies. Everybody's blaming the Fed for this surge in inflation. I think that's part of it. But as you know, the Fed was awfully easy for a decade and frustrated that they couldn't get inflation up even to 2%. I think what really changed is the fiscal stimulus. We basically saw helicopter money when the fiscal authorities handed out 3 rounds of checks, and that was accommodated by the Fed. That's really what got a demand shock to create a supply shock and cause this instant problem with inflation. And I think it could dissipate as the demand shock dissipates, as pent-up demand gets satisfied, and as the supply chain gets fewer kinks. Hans, hi, thanks so much. You're welcome. Do you have a view on the US dollar and what impact rate hikes might have? I've been relatively bullish on the dollar. I know there was a lot of bearishness about the dollar in the second half of the 2020s, of 2020, and even in 2021. But clearly, with the Fed talking more hawkish and now moving in a more hawkish direction, that's benefited the dollar. So I think that continues to be the case. Also, I'm not convinced that there's a lot more upside in commodity prices. I mean, we could always get a spike in oil, clearly, but copper's kind of hung in there around 4.4, 4.3 cents for quite some time. And there is an inverse correlation between the dollar and commodities. So I'm getting a little bit of a signal for commodity prices that the dollar may continue to remain relatively strong. Contributing to that is China's a mess, in my humble opinion. The growth rate is slowing down. It's probably slowing down more than they're acknowledging. They've got a problem with probably the greatest bubble of all times in real estate. And then, of course, they got demographic issues resulting from the one-child policy. So I'm not convinced that China is going to do very well in the next few years. And I think the market may very well be showing that in the strength of the dollar. Looks like we covered, well, no, we got more. Thank you. Okay, I'll do a couple more. Nick, JP Morgan and Goldman earning reports disclose significantly higher expenses due to labor. Does this indicate corporate America has a labor cost problem, which will result in disappointing earnings going forward? Good question. And labor costs definitely are going up across the board. I think a lot of companies, particularly in manufacturing, and believe it or not, even in services, are going to use the productivity to offset these higher wages. But clearly, in the short term here, wage pressures are mounting. When you compare wage increases to prices, a lot of the wage increases are being offset by the price increases, which clearly is not a sign that productivity is improving. So I think we do have a stagflationary patch here. I don't think this is anything like the 1970s. By the way, you can look forward tomorrow. I'm writing a piece with Debbie and Melissa on the 1940s. I know there's been some discussion about the inflation, the post-World War II inflation. So I look at that and think about the 1970s and the current environment now and then. So take a look at that. But all in all, I think you're making a good point here. And that is, for the next 6 months at least, we've got inflation that's going to show up. But yet, again, our weekly data on forward earnings, all-time record high. Our profit margins data is not going up, but it's not going down either. So that's kind of puzzling because those are really good weekly coincident indicators of actual earnings and actual profit margins. Andrew, could the Fed do less on Fed funds, risking overshoot, and do more via QT to keep the curve steep and encourage bank lending? I guess it's a good question, and I'm sure they're thinking about all these possibilities because the Fed funds rate has a very loud impact on the market. Everybody looks at it. It has an impact, direct impact on the bond market. It clearly unambiguously shows the Fed is tightening. Whereas if they do some of their tightening by letting their balance sheet not only run off, but actually sell off some of their bonds, that could push the bond yield higher relative to short-term rates. And at least the fixed income markets might get a signal that this is more sustainable for longer, because an ascending yield curve, the steeper it is, the more positive it is viewed for growth. The reason the yield curve typically narrows is because fixed income investors start to figure out that if the Fed continues to tighten, then something will blow up in the financial markets. That'll cause a credit crunch. That'll cause a recession. At least that's my interpretation of the yield curve. I wrote about it with Melissa in a short study that you can see on Amazon. But I think it's a good question. It's a good point. I guess I won't be surprised. It's kind of like a sort of Operation Twist, but in a different way than when they were trying to tighten more slowly. Bruce, how do you look at boomer retiring income portfolios? How would you balance for 2 million plus portfolio? Well, I think a lot of portfolios have been rebalancing out of equities because they've done so well and into bonds. And I see that in the data on bond mutual fund flows and bond ETF flows. For all the talk about Tina, that there is no alternative to stocks, last year was a record inflows into these kind of bond funds. So I would say that as these bond yields are going up, there is an opportunity to get better yields. I think a 2% bond yield may turn out to be fairly attractive for rebalancing purposes. But again, I think we're looking at an environment where it feels kind of like somewhere between an inflationary boom and stagflation. In the fourth quarter, the data is coming in suggesting an inflationary boom. And now with Omicron and other factors at work here, we may see something that looks more like stagflation in the first quarter of this year. And that may favor energy, may favor financials, and may create opportunities in technology to buy stocks that I think are going to be big winners for the long haul. I think we're going to call that it for now. I know there are a few other questions. Willem says, good to see you. Thank you very much. Good to see you all, or to participate with all of you on this call. And let's do this again next week. Have a great week, and see you soon.